This is Sebastian McMahon from IA Financial Group, and I'm here to bring you the weekly economic review for the week ending December 11, 2020. Again, this week, Mr. Gignac, our chief economist, has a scheduling problem, so doing this one solo. So I'll start with this week's markets at the close on Thursday. So positive week for equities in Canada and in EFI in emerging countries. So around the world, excluding the US. The US, we're seeing the weight of the failure of negotiations around a stimulus package to weigh on the market, and also it has outperformed so much during the year that now we're seeing a rotation of funds going out of the US and going elsewhere. Emerging markets in particular have had a very strong stretch in the last month or two. So 0.48% for the TSX. When you look in local currencies, positive 1.2% on EFI in emerging countries, and negative for the US. But when you bring everything back into Canadian dollars, well, you flip to negative for EFI in emerging because the Canadian dollar was strong on the week. Year to date, it was anyone who would have told me in the worst of March that we would be ending up with returns that look like we see here. So 8 to 10% return for bonds on the year, between 3 and 36% return for equities if you take the Nasdaq into account. If you remove it, you have like 10 to 15% return. Well, I would have been skeptical to say the least, but this is where we are. All in 2020 will have been a very decent year on financial markets. Price of oil up by 1% on the week. Canadian dollar and the euro both up versus the USD. It's more about the US dollar showing some signs of weakness recently, also because of all of the concerns about how they're handling the COVID situation, the failure to continue with some stimulation, and the fact that, well, the global economy seems to be doing well. So usually you have money that flows out of the US then and goes elsewhere around the world. So a weak US dollar should continue to be a theme in 2021. Price of gold down a little bit on the week, so volatile these days, but still up a very healthy 21% year to date. So COVID, an update on the current situation. So here again, the chart from Financial Times. This is the 7-day rolling average of new cases per 100,000 people population. So just to have a base of comparison. So first, Canada's not doing too bad when you compare to other countries, but when you look at the trend, well, we're not doing too good either. So we're at about 15 cases, 15 to 17 cases per 100,000 population, and it is still climbing, so the trend is not good. European Union, they were very active in putting some restrictions earlier during the fall, and they are reaping the benefits. They went from 50 cases per 100,000 people to about 27 now, so they cut it by close to 50%. So good news there. But in the US, still getting worse. We had a bit of a calm before the storm, before Thanksgiving. Everyone was looking at Thanksgiving and say, well, there's a risk that this thing gets worse, and it is getting worse. We went from 50 to 60 cases per 100,000 population. So the trend is accelerating again for the US. So if we stay in the US, there are some concerns on the labor market that are emerging. We've discussed that many times in the past, but I just wanted to go back on it. On the left, you have a chart showing that the number of jobs that were lost during the COVID recession was about 22 million. We've rebounded. We're back to about minus 10 million. So we're 56% of the way back, to be very precise, but 56% is still below the worst of the previous recession. So we're still below the bottom of 2007, and we're very far from getting back to the level that we saw in the previous recession, so the 1980, 1990, 2001 recession in the US. So the road ahead will be long and windy. On the right, you see the number of unemployed people for 27 weeks and over, so the long-term unemployment. So this is one figure where we put a lot of emphasis because the long-term unemployed, usually the more you have, the longer it takes to get back to a healthy labor market. As you can see this in the chart, that during the 2008-2009 recession, lots and lots of people fell in that category of long-term unemployed, and it took a very long time for these people to be able to get back into the labor force. You need to retrain, you need to move. To have a healthy labor market, you have to minimize the amount of people that become long-term unemployed, and we're still shooting up like a rocket. We're up now to 4 million people, so that's a lot. That's a lot of people, and we're about halfway through to the peak of 2008, 2010. So it's not a good sign for the U.S. labor market. And when you look at the unemployment rate, well, you might say, well, unemployment rate is lower in the US and in Canada, so they're doing better. Just wanted to bring to you that many people in the US are leaving the labor force altogether, so being discouraged and not seeking a job anymore. In Canada, the labor force participation rate has been rather stable. So when you compare both countries, on the left, you see that the unemployment rate, if you adjust it for the labor force contraction, you move from 6.5 to 8.5 unemployment. And that's pretty much bang in line with what we have in Canada. So we're actually doing the same on the unemployment side. The way that we have recovered the job losses in Canada, we've recovered 81% versus 56% in the US, so we're doing much better. And the long-term unemployment in Canada, we're doing much better. So the Canadian labor market has a good trajectory here compared to the one in the US. Finally, this week in Washington, because it's like a soap opera, still no package in sight. So you see on the left, Mr. McConnell, the Republican leader in the Senate, which he rejected the bipartisan COVID relief plan, and now the House, so the Congress is adjourning until the Tuesday of next week. So that brings us to December 15th. Of course, the government is saying that they want to have a package before Christmas, but it's looking harder and harder by the day. So maybe time will be putting some pressure on them to reach a deal. But so far, no deal, and the odds are shrinking. So that's what's weighing on investor sentiment in the US right now. That combined with the state of the labor market gives you a pretty dire picture. So financial markets. Asset allocation, equities remain favored versus bonds in our view. So of course the message, and we've been hammering this one for a while, but just want to get back on it to make sure that everyone has a clear understanding of our view. Equities may look expensive when you look them compared to their history, but you need to compare them to bonds. And on the left, you have the forward earnings yield. So how for every $100 of U.S. stocks the U.S. stock market that you own, do you get earnings, so profits from businesses? So the earnings yield somewhere around 4%. So for every $100 that you own of this S&P 500, businesses make $4 of profits. So that means that if you're a shareholder, you have a share of those profits, so you're making 4% there. And if you compare that to bonds, so if you own a bond, well, the interest rate is the earnings that you'll accrue from that. So if you compare the two, well, stocks remain very cheap compared to bonds. So stocks might look expensive, but bonds are much more expensive still, so you're better off holding equities than holding bonds. This is the message that you have here. If you look in a bit more in the shorter term on the right, you see that the equal weight index is outperforming the index now. So that means that the average stock is starting to outperform. Earlier this year, you had the average stock doing nothing, and the FANGs, so Facebook, Apple, Amazon, Netflix, and Microsoft, Google, those names were shooting up quite strongly. Now you're having the reverse. You have the big names maybe going sideways, and you have the average stock outperforming. So that means there's some breadth in the market. When you have breadth, that makes a market that's more resilient and that has more legs to run, so more room to run. So in the short term, we see the U.S. stock market as being a bit more resilient than what might appear to the naked eye. Still saying that, always yellow flag. The market is expensive. You can always make the case that it's good to be, well, it's always good to be diversified, but you can make the case that being strongly overweight equities might not be the way to go. You need to be diversified, because when you're this expensive, some interesting things can happen. And I'll look at IPOs in a few seconds. But now, if you look at the valuation of the US stock market, here you have a chart of the price to sales ratio, excluding the financials. Well, we're as expensive now, using this metric, as we were at the top of the dot-com bubble. And it's hard for accountants to fudge the numbers on sales. So it's not like, well, earnings are underreported and they're reinvesting and whatever. It's just not, it's the price to sales. The price to sales is expensive. And on the bottom, you see the same chart, but here you have it in percentiles. So you're at the 100th percentile. So you're as expensive as it's ever been in the past. Which brings us to this week's behavior. The market looks expensive, but it's still better to hold equities than bonds. Central banks are still putting lots of liquidity in the market. So what does that give you? That gives you some pockets of exuberance. So I'm not a stock picker. I won't be commenting on the business model of these companies. Just show you some anecdotes here that Airbnb, their stock started trading this week, and it skyrocketed 112% in its first day, giving it a market cap of 86.5 billion, and 86.5 billion is more than the combined market cap of all of the hotel chains in the US. So is it appropriate? I don't know. It's not my job to tell you that, but it does seem to be a bit much. DoorDash also came in earlier this week, trading at a steep premium to Uber and Grubhub. So DoorDash, a service that brings you food from restaurants to your home. It's a platform like Uber. They're not making any profits. They're making revenue, but they're not making profits, and they're trading at 17 times their revenue here now, compared to 7 times for Uber. So it's more than twice as expensive as Uber on this metrics. So is it the right valuation or not? I'll let you judge. But when you have lots of liquidity in the market, and the market seems expensive, well, you will be having these little pockets, little stories. So the moral of the story here is it might be a good idea. It might pay sometimes to chase the hot IPO or to chase the latest theme, but please don't invest using leverage in this environment first. And it's never a bad idea to take some profits. Nobody got poor by taking some profits. So just trade carefully in this kind of environment. But still, when you're in a diversified fund like ours, and you really chase these little themes, while being well diversified is one thing, and structurally being more overweight equities and underweight bonds, this is the recipe to have some better returns going forward. The TSX, will 2021 be the start of an outperformance versus Wall Street? We can ask the question. Here in this chart, you have two ratios. So you have in blue the ratio of earnings per share on the S&P 500 compared to the TSX. So when it goes higher, that means that you have an outperformance of the profitability of US companies. So as you can see, you had a cycle where the US was doing better from 86 to 1998. Then the Canadian stock market did better between 1998 and 2008. And then you had the S&P 500 doing better for the next 10 years. And now we can ask the question, well, is it time for a reversal? Maybe. We have the global economy that's doing better. Globalization is not dead after all. So when the global economy does better, you have the Canadian stock market doing better because we have more cyclicals in there, more value stocks in there. So 2021, we expect some good things from the TSX in 2021 compared to the S&P 500. Will it be the start of a strong move like that? We'll see, but we do favor, at least in the short term, the TSX. So what to watch next week? We're nearing the Christmas vacation, so every data is being published before that. So in Canada, we have housing starts, manufacturing sales, existing home sales, CPI inflation, and retail sales. Of course, expect slowing down of the Canadian economy in the fourth quarter with Quebec, then Ontario, and now Alberta, and you also have Manitoba in there. Provinces putting some strong restrictions. So of course, we'll have less growth in Q4, and all of these indicators will be giving us an idea of where we are standing now. And in the US, you'll have retail sales, the Fed, which should not change its view, and building permits and housing starts. So lots of things to look at next week. So that wraps it up for this week. If you want to follow us, ia.ca/economy. If you haven't done so, you can always subscribe on our webpage to get the weekly email. So thank you for your trust and thank you for your business. It's always a pleasure to be able to serve you. So if you have any question, you can reach us there. And I wish you a very good week. And we will be back next week, next Friday, with a new edition of the Weekly Economic Review.